Good morning everyone, welcome to another episode of the Mizuho Week Ahead. I am Boon Heng, market economist at Mizuho Bank. This week's theme is Undercurrents. The US yield curve boost deepened and US equities climbed as expectations of Fed rate cuts ramp up following dovish job warning by Bassett. Data, however, is far from clear-cut. While overall headline inflation in the US soared to 0.2% month-on-month, core inflation accelerated to 0.3% month-on-month amid elevated services inflation. Tariff-related categories also continued to see the cost pass-through, though the price momentum appears to be somewhat slowing. Meanwhile, producer prices rose much faster than expected, and the University of Michigan survey also showed that both near-term and long-term inflation expectations surged. That said, increasingly dovish views among Fed members and political buyers for dovish-leaning Fed displacements in the pipeline would likely lend some downside bias to US yields. Following country-level tariffs coming into effect last Friday, Trump appears to be shifting attention to corporates, with Trump ordering Nvidia and AMD to pay 15% of revenues to the US on exports of chips to China and reportedly discussing a stake in Intel. The Fed is not alone in that there are opposing undercurrents despite an overall trajectory to ease further. The Norges Bank held rates following a hotter than expected CPI print, but reiterated its plan to extend cautious easing later this year. Down under, the RBA cut their policy rate by 25 basis points to 3.6% in a unanimous decision, and downgraded both growth and inflation forecasts. While jobs data later in the week showed robust employment gains, this should not be mistaken for durable buoyancy. Point being, the strength of job creation momentum in Australia has overall moderated in 2025, and elevated job openings data imply that the occasional outsized gains remain. Looking ahead, our base case is 2 more cuts by Q1 2026 in a calibrated manner, but we could see deeper cuts premised on sharper economic slowdown. The Bank of Thailand voted unanimously to cut policy rate to 1.75% last week, citing negative credit growth, subdued consumption, trade and tourism headwinds, while acknowledging there is limited policy space ahead. We think that the next cut will likely be in late Q4, premised on continued growth slowdown and a lack of recovery in both credit quality and growth. In India, S&P Global Ratings upgraded India's rating from BB- to BBB with a stable outlook. The revision was a long time coming, given India's fiscal consolidation progress and economic growth, but rupee's gains may be subdued amid US trade antagonism and much of the improved fundamentals already priced in. Elsewhere, Singapore upgraded its 2025 economic growth projection to 1.5 to 2.5% from the previous 0 to 2%, following better than expected performance in the first half. In the week ahead, we expect Bank Indonesia to err on the side of caution, opting to defer the next cut to September's meeting to secure the rupiah's recent gains. Meanwhile, at the start of the week, Thailand's Q2 GDP is expected to remain stable at 3.1% amid the resumption of investment spending, robust manufacturing activity. But tourism sector could be the swing sector for this print amid contracting tourist arrivals. All in, navigating data, policy, and political undercurrents would mean bumpy yields and bumpy FX moves. For more information, please refer to our Mizuho publication or contact your respective sales desk and RMs. And for regular notification on our market views, please subscribe to our channel and hit the notification button. Thank you.